delivering crypto assets via the ETF wrapper has enabled access for both traditional and digital natives. Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site, we have Jay Jacobs, U.S. Head of Equity ETFs at BlackRock. Eliézer Ndinga, he is Head of Research, Global Head of Research, at 21 Shares, as well as Bill Birmingham, Managing Director at REX-Osprey. We're here to discuss why intelligent investors will focus on digital assets fundamentals with their portfolio selection. It is great to have all of you with us. Welcome to Trade Talks. Jay, let's kick off this conversation. When you think about digital assets in the context of this conversation, it's really about the allocations and what it means for the portfolio.
That's exactly right. We always look at digital assets as one component of a diversified portfolio. In fact, if you go back over a year ago, we published a paper describing how Bitcoin could be about 1 to 2% of a diversified portfolio. And at that level, Bitcoin is contributing about the same amount of risk as any of the Mag 7 stocks. And so when we look at the volatility we've seen this year, certainly thinking about it from a sizing perspective, that's a modest size, thinking about the correlations to other assets, it really helps investors stay invested for the long term to be able to not just kind of look at one asset and track the price every day, but to think about what's the impact it's having on a portfolio.
Yeah, and Eliézer, 21 Shares, you're thinking about it as a macro asset, and there are fundamentals for investors to be focused on.
No, absolutely. And when it comes to Bitcoin specifically as the largest asset, we've been a crypto asset manager for over 7 years in the space, and we always help the clients to really understand this asset class from a fundamentals perspective. So when we look at Bitcoin, Bitcoin is a long-term and emerging store of value. Despite the fact that we have micro headwinds and, of course, volatility in the markets, we've seen that, despite the fact that we had a drawdown of over 50%, we've seen less than 5% drawdowns from the alphas of these ETFs that we were able to launch throughout Europe as well as the US as well. So which is exciting because the investors understand the long-term outlook of the asset class, and also that Bitcoin is a companion to gold as a commodity allocation. And that's why we're incredibly excited to see the engagement from the clients to better understand the asset class, access for education. This is what we do really well at 21 Shares.
Yeah, and Bill, I think from REX-Osprey's point of view, every major new asset class goes through these periods of volatility. I mean, you call it the fifth asset class.
Yeah, our thesis is that crypto is kind of joined now among stocks, bonds, commodities, and real estate as kind of the fifth asset class. And like a lot of emerging asset classes, it goes through this period of kind of misunderstanding, high volatility, early adoption, and then it becomes institutional, and then it is an essential part of people's portfolios. I mean, most people couldn't imagine, real estate investment trusts before, apartment buildings became an asset class, and now, they're a fundamental part of, investor portfolios. So we see crypto going on that same kind of trajectory.
Yeah, I also think it's important to call out that there's a generational wealth transfer that's going to take place. And, you're looking at millennials and Gen Z, 70 trillion over the next 20 to 25 years, and they understand this.
When you talk to RIAs and you bring up digital assets, the ones that understand their clients that are, moving through the generational process, and they're having discussions with family members, in the various cohorts of that generation, they see the interest. And if an RIA is not in tune with this particular asset class, they're not going to be able to service that client. So we're trying to give them the tools to be part of the conversation for that new generation of investor.
Yeah. And Jay, I mean, you noted here that just even 1 to 2% can material shift risk-reward dynamics within one's portfolio.
That's right. So while Bitcoin's price changes, there's still things that we can take as more kind of fundamental properties of Bitcoin when we think about portfolio construction. One, it is a more volatile asset than the S&P 500, about 3 to 4 times the volatility, even if that volatility has been trending downwards over the longer term. And it tends to have a very low correlation to stocks and bonds. So therefore, when you think about it in the construct of a broader portfolio, it's really about doing something different. If you have a 60-40 portfolio, but want alternative assets that are going to behave differently in different macro environments, Bitcoin absolutely can play that role, just like gold could play that role, just like other liquid alt strategies can play that role. So thinking about it in that broader context and what it's going to bring to a portfolio can really help investors start to add Bitcoin to more portfolios.
And Ellie, it appears that investors are focusing on the digital asset fundamentals, and it's quite indicative to what you said before about the net inflows that you're seeing.
No, absolutely. And to Jay's point on the discipline of portfolio allocation in crypto, we've seen that rebalancing is key. So if they want to stay at a 2% allocation or 5% allocation, this is incredibly important to rebalance their portfolios to really meet that threshold. And what we've seen historically for the last 8 years at 21 shares is that the perfect rebalancing method is about on a quarterly basis to an annually basis to make sure that they can actually smooth out the volatility of the asset, despite the fact that we may have, of course, macroeconomic drawdowns or specific conditions that may lead the assets to also experience some significant downturns. So what we've seen so far is that there is an increase in demand for education, and this is why you've seen the sticky capital into these Bitcoin ETFs in the US.
Yeah, and something that you mentioned here as well, that the movement, the volatility that we've seen, it's rotation and selective allocation. It's not capitulation as it relates to investors.
No, absolutely. And I think historically what we've seen at 21 shares is that we've had multiple types of weather corrections or crypto winters or bear markets, right? So historically we've seen that the corrections happen within, let's say, 2 months or 3 months for a 23 to 30% drawdown, while the crypto winters last for 2.5 years and for 80+% drawdown. But the good thing with Bitcoin right now is that we've seen reduced volatility over the past 10 years because it's a more mature asset class. There is regulatory clarity. And most importantly, we have, of course, institutional grade vehicles in the market in the US and also in Europe and over markets to be able to invest through their banks and brokerage accounts into Bitcoin. So that's really the exciting part.
I mean, Bill, it does feel more institutional than it has before.
It really has finally reached that tipping point. You've seen endowments, you've seen sovereign wealth funds. I know Harvard recently allocated, close to $100 million to Bitcoin using an ETF wrapper. The sovereign wealth fund in Abu Dhabi has done similar. I think institutions are now starting to understand the duration of the asset. And so Bitcoin, unlike, other things, such as bonds and stocks, which go through various regimes, have to have all sorts of different sectors and companies underlying them. Bitcoin hasn't changed. It's the fundamental code. It's the same operational structure. It will be around for an extremely long time. And so I think institutions are now starting to see that as a valuable tool to match against other long duration assets and liabilities in their portfolios.
Yeah, and Jay, we're seeing a whole range of investors from dipping your toes into institutional investors. And of course, IBIT, very well known, and that's one of the ETFs that has been a catalyst for this type of adoption.
That's right. It's really happening across the spectrum. So for institutions, we've seen pension plans, we've seen endowments, we've seen hedge funds adopting digital assets in a meaningful way. With end investors, we actually saw that IBIT was one of the first access points for end investors to ETFs. We had over several 100,000 accounts open to buy IBIT, and that was the first ETF they had ever owned. So it's actually an on-ramp for a lot of people to broader ETF investing, which I think is just kind of a fascinating trend. And then in the middle, financial advisors, in many ways, they were restricted from being able to buy IBIT or ETH or Ethereum ETF in the first few months of them coming out. But that landscape has started to shift pretty meaningfully as well, as multiple platforms have now approved these products. So we're starting to see adoption in the financial advisor space, in the institutional space, and end investors. It's really bringing in more people than ever before.
Yeah, and you're also looking at ETFs in terms of staking and the underlying infrastructure, helping investors get exposure to that piece of the market.
Yeah, we offer two products that are natively staked. One is a Solana ETF. The other is an Ethereum. We believe in both of those networks and that we should support the underlying security of them, which is what staking is fundamentally for. And we're able to give investors yield through that process, and they're involved in that as well. So we think it's a critical piece of the crypto infrastructure. We're glad that we can provide a product that gives them, that extra bit of reward for it.
Yeah, I also think, a major hurdle was the Genius Act getting passed and understanding the framework around stable coins, because there are fundamental use cases for that. I mean, get their own tokenization there as well.
I mean, it is really a game changer for digital assets to be able to have US dollar denominated assets on chain. And, it comes with its drawbacks and its positives, but in general, I think it's really going to allow for, the widespread kind of spread of the asset class, and it will certainly enhance the maturity of it.
Yeah. And Ellie, you were focusing on European crypto ETPs. Do they approach the market in a different way than U.S. investors may, as an example?
I would say fundamentally, the questions that we receive from investors are the same. People want to understand how to value crypto assets like Bitcoin, how to allocate Bitcoin to a diversified portfolio, as we mentioned previously, and then most importantly, what are the fundamental metrics that they have to pay attention to. The beauty of blockchain technology is that this is transparent and that we can see in real time quarterly earnings reports 24/7, 365 days a year, which is really impressive. So you're able to basically measure the revenue, the user growth, and all of these various metrics that fundamental investors and value investors for the long run really care about. And the questions are the same. They're looking at this asset class as a long-term play in a diversified portfolio, and they are really eager for more education and understanding better how the dynamic also plays into the broader regulatory landscape.
Yeah, and Jay, what I'm hearing is it's the ETF wrapper that certainly has accelerated and enabled the access.
That's right. I think for so many investors, the hurdle of trying to get access to digital assets was just too high, trying to set up the infrastructure themselves or use imperfect instruments to try to track digital assets through other means, whether it's futures or individual stocks. So in many ways, IBIT, ETH, the broader ETP landscape has just created so many easy access points for investors. And we're seeing it in the volumes that are trading. Bitcoin, IBIT has had days where it's traded over $10 billion of notional value, a tremendous amount of liquidity, and in many instances where you're seeing the most liquidity for trading Bitcoin. So it's really kind of not only been an on-ramp for investors, an access point, but it's also become a really important liquidity tool for investors.
It's also more cost-effective as well.
It's very cost-effective to trade, and then you also have an entire options market around it, which allows people to generate income or use it for protection or other types of strategies. And so it's just created an entire ecosystem around IBIT to enable people to really get involved in the digital asset space.
Yeah, and Bill, let's talk about what's next, right, when it comes to innovation and creating more products around the digital asset space. I mean, it just seems like there's so much more now. What's next?
Well, I think that you're going to see more active ETFs in the space. I think people are going to start focusing on ways to, find kind of factors and, other ways to kind of slice and dice the digital asset market, into investable, pieces that are not as chain specific. I think you're going to see more indexing come to the market. Certainly there's plenty of exciting, primitives that are happening on chain. So, creating ETF wrappers for those will also be a big focus,
Yeah, especially the active management, because it almost reminds me in a weird, comparison to the fixed income market. It's so hard to replicate, right? What these managers are actively trading, and the digital asset space, it just continues to grow at such a rate that the active management, I understand that.
Yeah, it's a very
index perspective as well.
So from index perspective, I mean, I think that the ability to, it's a very Darwinian ecosystem, right? So you have a tremendous amount of turnover that happens within the digital asset space. And so for people who are looking for asset class exposure, indexing is a way to give them asset class returns. And I think that, for those who are really looking to trade individual assets, it's great that you have, individual ETFs, tied to specific chains and digital tokens. But I think, as this broadens out and as investors just want digital asset returns, then indexing is a way to give that to them, in a safe and kind of convenient, cost-effective way.
Yeah. And Ellie, it's the same question of you, when you think about what's next within this ecosystem, where's the innovation going to come from?
Right. I think it's good to take a step back first, because many investors think that cryptocurrencies are all the same, but they're actually not currencies. We have Bitcoin as an emerging store of value that looks like gold. We also have Ethereum, Solana that looks like app stores. So if you have an iPhone today, you're able to download an application like PayPal or Venmo. That's what Ethereum provides, which is basically the baseline infrastructure for that. So that's why we invented the geeks of cryptocurrencies called GCCS, to enable investors to classify cryptocurrencies based on sectors and industries and even the tokens as well, so that people can better understand what is next. So when it comes to what's next, to your question, we truly believe that this is a frontier technology alongside AI, robotics, and any others that people really care about. And that's why you're going to see a lot more different products, whether it's active strategies, baskets, long shorts, market neutral, but also I would say single trackers that would definitely help investors to have a directional bet on the next PayPal, on the next App Store, on the next digital gold as well.
Yeah, I think it's a great point that you made, that these emerging technologies, you can argue that they're under one basket. I mean, everyone's talking about AI on the chain.
Right.
Now, anyway, so Jay, to wrap up here, from BlackRock's perspective, what's next with the ecosystem?
I think the biggest thing is just more education around digital assets. It's always exciting to talk about innovation, but in many ways, you have to talk about adoption, not just innovation. And right now, we're still at the early stages for many of those groups I was mentioning, end investors, financial advisors, institutions. For many, before IBIT existed, it was very hard for them to even think about getting digital asset exposure. And now they're just starting that journey to understand what are these assets, how do they behave, how does it fit in a portfolio. So I think what's next is just more adoption and more education.
All right. Appreciate everyone's insight. Thanks for joining us on Trade Talks.
Thanks, Bill.
And thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.